Welcome to Investing Confidential. Whoa, what a day today. We had a ton of data, and we have Goldilocks, folks. If you heard it, if you haven't heard it, this is the financial press and Wall Street. They want you to make believe that they want you to believe this is Goldilocks, the perfect situation. We got exploding GDP, inflation coming down, consumer buying. This is what the numbers are saying. But as we know in the past, you got to look beyond the headlines. Okay, first on GDP, I'm not going to go through anymore. I mean, it just waste my time doing it, waste your time. Bottom line is, if you go through the numbers, GDP was driven up by government spending primarily and replenishing inventories. Okay, replenishing inventories and government spending is not the best type of GDP you want because the private sector not involved. And then they tell you that the consumers were active. I don't know where they're getting this information from. But if you look again, I'm not going to go through numbers, but if you look at the imports and the exports were strong. Okay, we exported a lot of stuff, primarily oil. And what did we import? Almost nothing. Almost nothing. Less than 1%. Like growth. It was almost nothing. What are imports? Folks, this is a consumption economy. Everything we consume is imported. We don't manufacture that stuff anymore. And if imports are down or weak, what does that tell you about the consumer and the economy? I mean, this is incredible. But it doesn't matter. As I told you, the market's going up. This is an election year. Washington realizes the only thing that matters is the S&P. It's funny to say, but that's reality. Wall Street realizes the only thing that matters is the S&P. They need to pump out tons of IPOs. The S&P has to go up. Their business is crippled. They need the S&P to go higher to at least make some money back. Okay, that's the bottom line. This is all about the S&P. Now, the inflation number they're using at the PCE, folks. Remember this. When it's all said and done, everything is still on average 30 to 40% more expensive. We haven't seen it come down. The rate of inflation, the growth is slowing, yes, but we haven't seen any deflation yet. That's to come. And they're wishing for this, but they're not going to like what happens when it does. But for now, it plays into the scenario. Okay. And as far as the consumer is concerned, I mean, I'm going to show you how this is absolute bunk. But let's start with the S&P. Let's look at the chart because that's the only thing that matters. As I told you, forget about everything else. Forget about GDP. It's all about the S&P 500. And let's start with a long-term chart. Okay, here's a long-term chart of the S&P. And what you can see here, folks, is that we really haven't had a bear market for a quite long time. And all of these plunges, including 2008, were just corrections. Long-term trend higher. Just corrections in a long-term trend higher. Okay, so you see 2008 and then a massive rip higher. You see COVID, massive rip higher. The powers that be today have enough money to make sure the S&P never stays down for long. Okay, so let's look at something more reasonable, which is a one-year chart of the S&P. Okay, and again, what you'll see here is in this October-November period where all the talk of recession, right? Everyone was talking about recession, because that's what the numbers were saying. That's what the numbers are still saying. But everything reversed. Everything reversed because these guys knew the Fed had no bones. The Fed was going to give in. Okay, whether they cut rates or not is most likely not anytime soon because you got hot numbers. So again, be careful what you wish for. Be careful what you wish for. So at the end of the day, going back now to a 5-year chart of the S, a little bit longer term, you've got the COVID bottom, massive run up. You had a dip because of the recession fears, and now we're at all-time highs. We're at all-time highs. Valuations are out of control, but no one cares. Magnificent Seven, again, if you're not in these 7 stocks, you haven't participated in this run-up. You haven't participated. It's, again, going back to everything else. This is an illiquid market, believe it or not. It's not liquid like it used to be. And so anything illiquid can be manipulated. But the reality is this market going down? No, folks. No, it's not. So if you're riding, just keep riding. But this isn't reality. Okay, let's look at reality. Okay, first that we're going to look at is the amount. So they're telling you the economy is booming. They're telling you we have no unemployment. They're telling you inflation is coming down. They're telling you all these great things. Let's look at the reality. Let's look at the amount of people that are getting laid off. And I'm talking about high-priced workers. So here's the numbers. I apologize for the small print, but there's so many companies laying off. It's just I want you to see everything. You use your magnifying glass on this. So you've got Amazon, BlackRock, Citibank, Bloomberg, across the board, Rubbermaid, Xerox, Pizza Hut, every tech company you could imagine, including Apple. They're all laying off people. This is recent. How does a booming economy with massive layoffs? Does this make any sense? Does this make any sense? To me, it doesn't. But yet, they tell you there's no unemployment. Okay, well, let's look at the real numbers. Let's look at here we have the establishment. Okay, this is the deep state, the government, and Wall Street surveys versus household surveys. Look at the crash. The real economy, Main Street, suffering, but they hide the numbers. They don't want you to see that. They hide the numbers. Here's another. So the establishment survey is showing one thing, and the real economy is showing something else. As I told you in the last video, 90%, less than 10% of the population owns 90% of the S&P. They own the stock. You don't own the stocks. You have some funds that are underperforming. And if you went and I showed you before, if you got into hedge funds and private equity, you're into the worst drag. You're not making any money. And the reality of the numbers tell you something else. The government numbers, and again, these are government agencies telling you one thing, but the realization is the other. And here's the realization. Again, I don't want to be political here, but you've had a massive movement, and they call it a shadow pool, foreign workers, most of them now coming over the border. Look at the percentage. It's massive. These are non-Americans, shadow pool workers. It's exploding. Okay, not in the numbers. They don't want you to see that. And then you've got defaults, auto loan defaults. Okay, look at the delinquency rate. Ask yourself. The government's telling you we have a booming. Joe Biden's going to get on tonight and tell you we have a booming economy. Wall Street tells you the consumer is strong. How on earth do you have a 10-year high going on to a 15-year high in delinquency rates of auto loans? And how on earth do we have a strong economy when it's all but it's all built on credit? It's all built on credit. It's just growing. There's no end to it. $5 trillion in consumer credit. Out of control. And just one other thing I'll throw in here, because it's not US, but it's global, because it's happening here. Apple Computer, the great Apple Computer. They've never discounted ever, ever. Well, they're discounting now in China. And if you think it's not coming here, you think wrong. Okay, so all of this tells you what's really happening. And the government numbers, Wall Street, seeing all the financial press, they're all telling you something completely different. Who do you believe? Well, if you're an investor, stay invested in the short term because the S&P is going up. It broke all-time highs. They need it to be up. There's no liquidity, so they can keep it up. They're just going to keep buying it. So ride the wave. When it's going down, I have no idea, but it will. The longer it goes up, the more brutal downside we're going to have because this is valuations are too high. We're at like 30 times earnings. People like Apple are at these tech stocks like 50 times earnings. It's unsustainable, but no one cares. So I'm not going to bother talking about it. And then there's real estate. You're obviously not paying attention to it because it's not in the mainstream press, but we finally have the first signs of the beginning of the end to the real estate bubble, which is good for you guys who haven't been able to buy a house because of Wall Street pricing you out. People like Blackstone buying up all the homes. And that's fact now. When I first called it, no one was talking about it. Now it's fact. And no one's paying attention. So let's look at this. Here we have some of the companies now are telling their workers, you either come back to the office or you'll be fired or you'll be downgraded. Okay, all the banks. But it's not just the banks, it's everybody. Here we have another indicator, Wayfair, okay, big furniture company, etc., consumer. Layoffs focused on remote workers. It's just two little things, but it's happening everywhere. Why is that important? Remember, folks, you may be one of them sitting out there. The real estate market exploded for two reasons. One, Wall Street bought up the supply. And number two, people wanted to get out of the cities, wanted to go remote. The companies told them, hey, you could be remote for a long time, maybe forever. So they went out and just bought second homes everywhere. Everywhere. And now, chicken's coming home to roost. They're telling you to get back. And the economy is not booming anymore, as I showed you, even though the S&P's up. Now some of these people have two homes. One of them, they don't need anymore. They got to go back. They got to travel across the country. They got to sell their house in Texas. They got to sell their house in Vermont. They got to sell their second home in Massachusetts or wherever it is. And then the supply is going to come on. Supply is going to come on. And that's going to be a problem. And we're already seeing that in the rental market. Okay, here we are. Apartment supply. Hitting this year the highest since 1974, folks. 1974. Overbuilding. People bought up a bunch of apartments to rent them. And the chickens now are coming home to roost. Okay? So here we show apartment vacancies. Just in time with all these apartments coming to the market, we have vacancies at the highs. I mean, 2 and 2 always equals 4. At least the way I calculate it. The government, 2 and 2 equals 10. But 2 and 2 always equals 4. And the bottom line is that we are in a Goldilocks situation. That's what they tell us. So you have to believe it. They want you to believe it. The S&P is in a Goldilocks situation. It's breaking new highs. The Dow's up over new highs. Nasdaq's up. You can't fight it. You can't fight it. But it's all fake. I just showed you. I mean, it's good for the 5% of individuals around the United States who own all the stocks. They're doing really well. But for the rest of the economy, not so good. So, look, we have election year, so make your own conclusions. The economy needs to be strong. The S&P needs to be up during election year, because if it's not, the incumbent's going to lose. And no one cares. The data, people believe the data until they don't. So at the end of the day, market breaking highs, Goldilocks. So it's like a shiny apple that's rotten in the core. But as long as it stays shiny, no one cares. But hope is coming, especially in real estate market, and you're going to see it come in hard. And that will begin this whole deflationary spiral lower and end this massive movement, dollar strong movement. And we're going to enter into a weak dollar time. And that's when the chickens will definitely come home to roost. So if you're an investor, enjoy the ride, but be careful out there.